Dear students, now we are going to see Unit 8, Physical and Monetary Policy. So what is this physical and monetary policy? And this unit coming under economic environment. This is one of the part in economic environment. So economic environment, as we discussed already, this economic environment is surrounding the business. There are so many things economically. So what are those things? So regarding that only in this unit we are going to see. So what are the various policies the government is adopting through RBI and other banks? All those things we are going to see in this. Now what is fiscal policy? Fiscal policy. Fiscal policy is a means by which a government adjusts its spending levels and tax rates to monitor and influence a nation's economy. So it is the policy of the government to make adjustment the spending levels and tax rates, to adjustments of the tax rates. So spending level means the government having more, suppose capital expenditure. The government is doing some capital expenditure. A very big building, the construction, dam construction, bridges construction. Such things, crores and crores of amount goes out. When more and more in outflow of the money to the public, automatically the inflation rate will increase. So suddenly, when the inflation goes up, so immediately they will get back that. That is, the expenditures will get less, will get reduced. So this adjustments and the way of tax rates are coming under this fiscal policy. All these are what for? To stabilize, to have the same platform of the nation's economy. Fiscal policy measures are initiated by governments to stabilize the economy, specifically by influencing the levels and allocations of taxes and government expenditures. So these things are for stabilizing the economy. So the economic level to be stabilized, it is not one day up, another day down. Then people will get confused. The other nations, abroad people, they also will get confused. And the persons those who want to have a trade with us, they also will get confused. So in order to maintain a same economic level, the sustainable level, so the government must take these initiatives. Fiscal measures are frequently used in monetary policy to achieve certain goals. So the fiscal policy and monetary policy go side by side. So the fiscal policy, the diagram, what are the various things the fiscal policy has to concentrate. It has to concentrate the growth, expenditure and investment, tax, national economy, rate, revenue, finance, inflation, asset, allocation of expenses, income level, business, all these things. Government must keep it in his mind before he levies all the policies. Now, it's mainly involved in taxes and expenditures. It acts within the government control. Within the government control. The effects of these policies are predictable. It is predictable. So it is very clear actually when a child gets 100 rupees, what he will do? He'll go and buy some juice and some sweets. Suppose the same child having 1,000 rupees, then suddenly he will go for purchase some other dress, this, that, and all. But no child like to keep this 1,000 rupees for saving for next day. No one will do that. So, So this is a predictable thing. When money goes out, what will happen? When money comes, what is happening? It is a predictable effect in the economy. Next, a reduction in the tax burden on the corporate sector will increase the investment. So the tax burden in the corporate sector is really it's only 30 percentage, and then tax to tax surcharge, all those things are there. But when any tax rates are getting reduced or any concessions or anything, when they are announcing, so suddenly what will happen? The investments that more project, next project, the corporate people will go ahead. In the same way, government expenditure on public works will give effect on the expansion and increase in public income. So the expansion, government expenditure, that is what I told you, building dams, bridges. So all those or the expansion of all this, suppose new buildings. So this increases the public income. Public income is getting their standard of living, all those things. Suppose some 500 crores amount, they are purchasing, they are building a dam or they are building a very big over bridge. So in that situation, definitely those amount will go to the public only. In any one way, labor or material, any way, it increases the income level of the public. So their standards are automatically, when they get money, automatically their standard of living is getting increased. Next comes what is monetary policy. A monetary policy is a policy of the central bank. Central bank means Reserve Bank of India. Okay. So central bank for using the monetary policy instruments by the act and according to the national economic level. So this monetary policy RBI is initiating. So what are the various instruments? How they are initiating? That is only we are going to see. So this both fiscal policy and monetary policy both go side by side only. It's sister policy, they say like that. Sister strategy, they say that. So the chart tells you what monetary policy. So flexible inflation targeting framework, monetary policy committee is there, instruments are there, monetary policy instruments are there. So how they are going to implement this monetary policy? Those things. Monetary policy process, the process of monetary policy. Monetary policy framework. They have to do all this. If this goes, then what will happen? If that happens, what we have to do? So all this framework. Okay. During the month of May 2016, the RBI Act had been amended to provide a basic for implementation of flexible inflation targeting framework. So the inflation to be controlled, main aim of that is the inflation, it has to be controlled. So how inflation can be, what is the inflation? The first of all, we should know the meaning of inflation. What is inflation? Yeah, inflation is continuous increase in the price. Continuous increase in the price is not at all good for the economic level. The price level should not continuously get increased. Because the person, what he will think, na, for tomorrow it will be 110, the next day after tomorrow it will be 120. So suddenly today itself he thought of purchasing everything and keeping. So for sudden purchase in everybody goes for sudden purchase, what will happen? Then rates will get high increase. So this is what happened for the lockdown period and all. Suddenly when they announced the lockdown, on Sunday it's a lockdown. So on Saturday, what is happening? All the shops, heavy crowded. All snacks, this, that, heavy crowded. And the rates suddenly increase. So because that much only the available price, available product, and more and more demand. So what is happening? got prices to the steep level. So suddenly what government did, what that local authority board and all, what they did, they supplied all the things, that is vegetables, these, that, they supplied to road by road. 4 5 vehicles with that they supplied. Direct supply. They did. Once such a supply comes now, then the rates suddenly got decreased. So these things the RBI has to keep it in mind before it starts implementing any policy. But the basic thing of monetary policy is to keep up or to keep in the same level the inflation. That is the very basic policy. That is a very basic strategy of having this inflation, this monetary policy. So objectives of fiscal and monetary policy. What are the various objectives? To maintain full employment. So full employment. So when more government expenditure and this, that and all happening, then what is happening? So many people, they get employed. They'll be getting employed. That is maintain high rate of economic growth. So when the exchange, all these things are continuously being maintained, so constant economic growth will be there. To stabilize wages, always there is a separate acts are there for wages. Minimum wages act, okay, and then wages and compensation act, wages and salaries compensation act. So all these things were there, and for the wages, so there are 3 4 methodologies for calculating the wages. So all these things were being maintained. So the labor law keeps close eye on the wages of these laborers. The wages to be stabilized. If not, what will happen? Money will not go to the laborers. They don't buy. Again, problem in production. It's a chain. To develop proper tools to achieve correct monetary policy. Proper tools to achieve. To develop proper tools to achieve correct monetary policy. So they have to implement correct tool. What is this tool? That. So for this situation, what we have to announce, that is to maintain the price level and keep sustainable growth. Price level to be maintained. If they maintain the price level, then the growth will be with the slow. It will be in the progress. So instruments, quantitative and qualitative. That is selective control credits, they say. Open market operations, bank rate, cash reserve ratio, then under selective control credits, credit rationing, margin lending, then moral ratio. So these are some of the instruments of monetary policy. There are two kinds of instruments, direct tools or instruments and indirect tools. So what are these direct tools and indirect tools? Repo rate. It is a fixed rate of interest the RBI provides for overnight liquidity to banks against the collateral of government and approved securities. So, actually, the banks are keeping, that is, the banks have certain reserve with Reserve Bank of India. All the commercial banks must have some reserve, must have some balance, must have some amount with the Reserve Bank. So, changing those interest rates for the reserve will have the impact on these commercial banks. So reverse repo rate is the rates, what if they are, which is a very simple thing. Let me explain in this way. Suppose a person, a normal working person, he is earning 50,000 rupees. Okay. The bank gives a 10% interest. Example. Okay. Banks gives 10% interest. So what he thinks, better he will go and deposit. 10,000 he is depositing. Out of 50,000, 10,000 he is depositing. So next month, what is happening? The bank announces 11% interest. Oh, 11% increase. Better. Why can't we increase this investment? Better we will keep 12,000 rupees. So out of his total savings, 12,000 rupees is keeping as saving and remaining amount only is. So his spending level is getting decreased. When the interest rate is increased, his spending amount is getting decreased. So that is the same concept prevails there also. When the interest rate increases, they keep more money. And when the money is with the reserve, what is happening? Then here the loans all will get reduced. So this rates they adjust, and according to that, the amount circulation is getting controlled. Reverse repo rate is quite reverse to the repo rate. Liquidity adjustment facility is liquidity actions and term liquidity. Liquidity means one bank then another bank how they transaction. That amount whatever they give as loan. So those things are coming under this liquidity process. Marginal standing facility. Certain amount is always kept as reserve. Once, if they are increasing those reserve, government RBI says, so instead of keeping 1 lakh rupees, you should keep 1,50,000. So immediately, okay, all the banks are keeping 1,50,000. Then what is happening? It won't give much lending. Suddenly, RBI says, you keep only 1 lakh rupees, so 50,000 rupees extra, that they will give it for a lending purpose. So this liquidity ratio, the RBI is insisting on the banks to keep certain amount as their reserve. So the bank rate, the same thing, bank rate, bill of exchange. So what is this bill of exchange? Many students have this very poor knowledge on this bill of exchange. They're not much clear on this bill of exchange. So let me explain this with a small example. Suppose X purchasing 1 lakh rupees worth about goods with Y. X is the purchaser, Y is the seller. X has to pay 1 lakh rupees to Y. Okay, clear? X does not have money. X is asking 3 months credit for payment. Y is giving. Okay. So what Y is doing, he cannot believe X, 1 lakh rupees. So Y is writing the instrument, getting the signature, acceptance, that is called acceptance. 2 copies he will prepare, one he will give it to X and another he will take it, keep it. Now, after a month, Y needs certain amount. So what the Y will do? Y will take this bill to the bank, take it to the bank, and the bank will discount. The bank will discount the bill for certain how many 2 months more now 18 percentage for that the rate of interest is 18 percentage 16 percentage it will discount and certain amount he will take. So 1 lakh rupees for 2 months 18 percentage, what is that amount that they will deduct it and they will give. Okay, what is the rule now? After exactly 2 months over, when the due date comes, what this bank will go to X house and I will ask money. The X will pay 1 lakh rupees. So this amount, in case he gives 95,000 and he takes 1 lakh, so 5,000 is the benefit for bank. So that is example only, I did not calculate now. So what is it, 18 percentage and all, I did not calculate. Okay, some example I am giving, 5,000 is the discount. So what is in this the bank like this bill of exchange, so many bill of exchange collected and discounted so much. Now what bank will do? All this commercial bank, all this bank bills taking to the reserve bank, and the reserve again they will rediscount it. So the RBI will rediscount all these bills with some interest. Now 18, but they will take for some 5-6% they will take. Example. Okay. So this discount rate also they will change it. In case if the RBI so charging a 10 percentage or 12 percentage interest for this now. Okay, for 5-6 percentage, why do all this risk? Better we are not discounting. Bill of exchange we are not discounting. They'll reject the customer. Okay, so like this is called a bank rate. What is the RBI charging rate for rediscounting the bill of exchange to the commercial banks are called a bank rate. Cash reserve ratio. What is cash reserve ratio? So I told you already what is this cash reserve. So what is the cash balance minimum they have to keep it with the RBI? So that is called a cash reserve ratio. Okay, certain this much deposits you are having, then this much amount you should keep it here in the RBI. So that is the ratio what they have. CRR they will say. Next. So bill of exchange, I told you now only all this example. The same thing. The terms and mode of repayment. In this bill of exchange, one thing I left to say, there are three parties. One party is a drawer who is writing the bill. So yeah, X is the purchaser, Y is the seller. I told you on behalf of Y, Z is writing mark. It is not the job of Y all the time to sit and write. So Z, he is entrusting the to Z. Now Z is writing. Z is the drawer. He writes. Na? On whom behalf he wrote? Y. So X. Sorry, X. X is a drawee. X will pay the money to whom? Y. Y is the pay. So normally in the bill of exchange there are three parties. Okay. In case if the bill is discounted, who will be the paying? Bank will be the pay. Monetary Policy Committee. So it is constituted by the central government to decide the policy interest rate required to achieve the goals of the policy. Okay. The committee has 6 members. 3 members are represented from the RBI, and the 3 will be nominated by the Government of India. The chairperson and ex officio of this, the governor of the RBI. The governor of the RBI is a chairperson. Okay. Major objectives of this committee to bring more transparency and accountability into the decision-making process of India's monetary policy. More transparency, whatever the decisions, whatever that they take, it must be transparent and it must be accountable. The current inflation rate to be maintained is 4% until March 2021. So it in the upper limit is 6% and the lower limit is 2%. This they are maintained. And they have a very keen observation towards us. And this rate should not get increased. The committee is liable and will be questioned by the government on the failure of maintaining the inflation rate. In case if anything happens, the suddenly now what our petrol diesel rates got decreased. Na? Suddenly they decreased the rate of interest, they decreased the tax rate, and the rate of this petrol diesel got reduced. So they got that idea, okay, continuously it is increasing. Oh God, what to do? Decrease the rate of tax. Okay. So in case if the committee is not fulfilling the duty properly, the government of India will question. Okay. Then comes next. This monetary and physical measures for international payment and exchange. So monetary policy is the main area of a national central bank. The Federal Reserve System. Okay, this what are the various instrument open market operations, discount rate and reserve requirement. I told you open market operations are in suddenly that is the rate of interest. Rate of interest for the deposits, I told you the example. So instead of 10 percentage, 12, 11 percentage, then immediately the person depositing more. So increasing the rate of interest and controlling the cash, pulling the cash inside. When inflation rate goes up, now they will do this one. Then inflation rate got reduced. All the prices are decreasing. What to do? So suddenly they'll call everyone. Okay, come, take money, take loan, go purchase. Okay, so that is the open market operations. Flow of cash in the open market. When more inflation suddenly pull that. So this is open market operation. And discount rate I told you and reserve requirement I. Now what is the major differences between monetary and fiscal policy? It is a financial tool that is used by the central banks in regulating the flow of money and the interest rate. That is monetary policy. It is a financial tool that is used by the central bank. It is also used by the central government, central bank, and this is central government. That is bank, this is government. So they lay the policy and they will give it to the RBI. It is managed by central bank and it is managed by Ministry of Finance of an economy. Okay. So what is the focus area? Stability of an economy. That is monetary policy focusing. Okay, it measures the interest. It measures the previous pointer. It measures the interest rates applicable for lending money in the economy. It measures the capital expenditure and taxes on an economy. So this is the interest rate, that is capital expenditure. Capital expenditure, then I told you, construction of very big building, dam, all those things. Capital expenditure, very big research and development projects, all those are capital expenditure. Examples. Then stability of an economy, this is growth of an economy. Then exchange rates improve when there is higher interest rates. It has no impact on the exchange rate and all, they concentrate on this economy. Because all these exchange rates are governed by the central bank only, that is RBI only. Monetary policy targets inflation in an economy. Fiscal policy does not have any specific target. They don't have the target, and because they are government, they take policy and they give it to the RBI to execute. Monetary policy has an impact on the borrowing in an economy. So fiscal policy has an impact on budget. Okay. So with this, we will end up this unit. Fiscal policy, monetary policy. There are various instruments. So what is fiscal policy? What is monetary policy? And how it is executed? How the committee, what is the committee, monetary policy committee, what is the monetary policy committee, and who are the members of the committee, and what are the major objectives of the monetary policy or the committee. Then international exchange, what is the main points, what are the major differences between monetary policy and fiscal policy. These things we have we saw in this unit. With this, I request you all to go through all these lecture notes given elaborately and to go through the assessments. This monetary policy and economic policy and RBI functions we are going to study in the next units. RBI functions, department of RBI, various departments of RBI, commercial banks functions. But on the whole, one thing you all must be very clear. Why this particular unit? What is the necessity of keeping this unit? Because economic environment is highly needed for the business. So one business surrounding, because business is not going to run in a forest area. It's in the it's in the society. Surrounding what is, suppose inflation is going or deflation or raw material cost is increasing or decreasing. What is the supply? What is the level of the wages, employee salary? So all these things need to be checked before the businessman he executes the business. That's what, for the business environment subject, this economic environment is given as a block, and in that this physical and monetary policy is a unit. Okay, so wish you all good luck. Go through the lesson given, that is lecture notes. Okay, thank you.